Apple stock just closed at $266.17.
Right, which is quite a move.
Yeah, it's down over 2.5% in a single day, and honestly, it's caught in this really tight falling trend.
It definitely is.
So if you're looking at your portfolio right now, you really have to be asking yourself, is this a flashing sell signal? Or is the stock, secretly undervalued right before a massive breakout?
That is the million-dollar question today.
Exactly. Welcome to your custom deep dive. Today, we are just tearing through this massive stack of financial statements, technical charts, insider trading logs, and analyst ratings.
Yeah, we have a lot of ground to cover.
We really do. We are trying to figure out exactly what is happening with Apple as of today, April 22nd, 2026.
But we should probably put a disclaimer out there first.
Oh, absolutely.
Yeah.
We have to state right up front, this deep dive is just an analysis and a debate of the provided source material. We are absolutely not giving any financial advice here.
Right, no financial advice at all. We're just looking at the data.
We're just here to read the terrain. And before we get into the numbers, if you're listening or watching on our YouTube channel, make sure to like the video, subscribe, and you must leave a comment with your feedback.
Yeah, it really tells us what you want us to dive into next.
So getting into it, you're right to ask if this is a sell signal or a breakout setup, because the landscape around Apple right now is just a minefield of conflicting data.
It really is. And getting into the actual mechanics of what's driving this stock is, well, it's the only way we start to make sense of all the noise.
And there is so much noise. But if we are going to debate where the stock is headed tomorrow, we have to establish a bedrock, right?
Definitely. We need to look at the foundation first.
Yeah, we need to know what this company's actually worth right now and how it performed when it last opened its books.
Right. So looking at the price action.
Yeah, the stock closed at $266.17 on April 21st. It's sitting in this consolidation phase.
Which puts it about 8.5% below its 52-week high, right?
Exactly. That high was $288.62. If you zoom out, the 52-week range goes all the way from 189.81 up to that near 289 peak.
That's a pretty massive range for a company of that size.
It is. But then you look at the company's actual performance, like the Q1 2026 income statement, and it's just a wall of record-breaking results.
No, it's staggering.
We are talking all-time highs for iPhone and services revenue. Total revenue was $143.8 billion.
Which is, what, up 16%?
Up 16% year over year. Net income hit $42.1 billion.
Up 19%.
Right. And diluted earnings per share came in at $2.84.
I mean, those figures are just incredible, but we really need to look at how they're actually achieving that.
What do you mean?
Well, to grow total revenue by 16% when you are already generating over $140 billion a quarter, that isn't just a standard corporate win.
Right, it's huge.
It requires an operational miracle. They aren't just selling more phones, They're maximizing the cash they extract from every single user.
The services revenue.
Exactly. That all-time high in services revenue, meaning Apple Music, iCloud storage, the App Store cuts, that's crucial.
Because the margins are better.
Way better. Services have a much higher profit margin than physical hardware. So when you see net income jumping 19%, actively outpacing the revenue growth,
it tells you they're getting significantly more profitable at a structural level.
Precisely.
Which totally explains the balance sheet, which is, frankly, the size of a small country's GDP.
It really is.
They reported roughly $54 billion in operating cash flow just for the December quarter alone.
That's just cash coming through the door in 3 months.
Right. And as of late December 2025, they had $45.3 billion in pure cash and equivalents just sitting there.
A massive war chest.
With total assets sitting at $359.2 billion. So, okay, here is the huge disconnect for anyone holding this stock right now.
The price action.
Exactly. With such staggering, record-breaking revenue and this impenetrable balance sheet, why is the price stuck in this tight consolidation phase instead of rocketing to new all-time highs?
It's a great question, and it comes down to the inherent difference between trailing fundamentals and forward-looking market mechanics.
Trailing versus forward-looking, okay. Break that down.
Well, when a company reports $42 billion in net income, that tells you what happened yesterday, right?
Sure. It's in the past.
It proves they are a cash-generating behemoth. But the stock market doesn't buy shares to reward past behavior. It buys them to capture future growth.
So the market already knew this was coming.
Exactly. If the market has already, priced in perfection, meaning hedge funds and institutional investors fully expected those massive iPhone and services numbers months ago, then simply hitting those targets isn't enough to propel the stock higher.
They need a surprise.
Right. The market is effectively taking a breath.
Yeah.
They are looking at that 16% growth and saying, great, but can you do it again next quarter?
So that's why even the strongest companies can drift sideways after a blowout earnings report.
Exactly.
So if a $42 billion blowout quarter isn't enough to push the stock price up, we really have to stop looking at the spreadsheets and, well, start looking at the trading floor.
We need to look at the charts.
Yeah, we need to see the actual real-time tug-of-war happening between buyers and sellers right now. And the technical charts are telling a very specific story.
They are, and honestly, it's a story of extreme compression. The market is essentially coiling a spring.
Okay, let's unpack how that spring is coiling. The trend direction is officially listed as neutral or sideways.
It's totally flat.
The stock is trapped, right? Consolidating really tightly between $250 and $260.
Right, it's stuck in a channel.
And if we map out the floors and ceilings, the primary support, the floor, is at $250, with a secondary lower support at $257.
Wait, I think you mean secondary support at 250 and current support around 257.
Yes, right. And on the flip side, you have minor resistance at 260 and major resistance acting as a hard ceiling at 272.61.
It's boxed in.
Completely. And the indicators reflect this standoff perfectly. The 14-day RSI is hovering around 53.05.
Which is incredibly neutral.
Yeah, and for anyone who doesn't stare at charts all day, the RSI basically measures if a stock is being overbought or oversold, right? So if 53 is dead center.
Precisely. It means neither the buyers nor the sellers have control right now.
What about the MACD?
The MACD, which is another indicator that tracks the stock's actual momentum, is completely flat.
Just a flat line.
Yeah, there is zero directional energy pushing it up or down. Though it is worth noting that if you look at the long game, the 200-day simple moving average is way down at 240.58.
Okay, so because the current price is well above that 240 level, the long-term multi-month uptrend is technically still intact.
Technically, yes. But the short term is where things get really dicey.
Extremely dicey. The chart shows a rejection at the top of what's called a descending triangle pattern.
Which is a classic bearish setup.
Yeah. The sources point out that if the stock can't clear that 270 resistance, it faces a potential short-term bearish leg downward.
It's a heavy warning sign.
Now, a descending triangle sounds highly technical, but it's basically a fancy way of saying it tried to rally and slammed into a ceiling, right?
That's exactly what it means.
So why do retail traders, everyday investors, often get trapped in these exact technical setups?
Well, let's visualize that descending triangle. Think of it like a trash compactor.
A trash compactor. Okay, I'm listening.
You have a solid floor at the $250 support level. But every time the stock tries to bounce off that floor, it doesn't bounce quite as high as the last time.
The highs are getting lower.
Exactly. It's slamming into a ceiling, but that ceiling is slowly lowering, literally crushing the stock against the 250 floor.
Wow. Okay, so it's a literal trash compactor.
Yeah.
And the trap springs when retail traders see the stock hit the floor of that compactor and mistake it for a permanent safety net.
That's the retail trap. Imagine you are an everyday investor holding Apple. You see the stock drop a few dollars and bounce off that 250 mark, and you think, great, I'm buying the dip.
You just see a temporary discount.
Right. You assume the stock will naturally bounce all the way back up to 288. But what you're missing is that the underlying momentum is just draining away.
The algorithms see it, though.
Oh, absolutely. The big institutional algorithms are watching this compression, too. When that solid 250 floor finally breaks, those algorithms trigger automatic sell orders.
Stop-loss hunting.
Precisely. A cascade of automated selling hits the market all at once, causing a sudden, violent drop.
And the retail trader is just left holding the bag.
Suddenly trapped, holding a declining asset, watching the price plummet to 240, wondering why the company's strong fundamentals didn't save them.
Because they didn't realize they were buying into a structural breakdown.
Exactly.
Wow. So if we're looking at a potential trash compactor situation, we really need to know what the smart money is doing right now.
Always follow the smart money.
Right. If everyday investors are at risk of being trapped, are the insiders and institutions buying the dip? Or are they quietly heading for the exits? Let's look at the options market first.
The order flow is interesting here.
It is. It shows a put-call ratio of 0.67. Now, since anything under 1.0 generally means more calls than puts, the options market is leaning bullish, right?
Yes, traders are placing bets that the price goes up.
But then you pull the insider activity from early April 2026, and the heavy hitters are selling.
Some very big names.
Huge names.
Huh?
CEO Tim Cook sold just shy of 65,000 shares at an average price of $254.23.
And he wasn't the only one.
No, the senior vice president of retail, Deirdre O'Brien, sold about 30,000 shares at $255.35.
Right around that same time.
And then layer on top of that, we know Berkshire Hathaway has previously reduced its stake in the company.
Warren Buffett trimming his position.
Right. Here's where it gets really interesting. The options traders are betting on the stock to go up. But if the CEO is cashing out roughly 65,000 shares right near this critical support level, shouldn't we be worried?
It is incredibly tempting to see the CEO selling 65,000 shares near a critical support level and assume he knows something terrible is coming.
I mean, it looks bad.
It does, but we have to look at the actual mechanics of insider selling. Executives at this level almost exclusively use what are called 10b5-1 trading plans.
Right, the automated plans.
Exactly. These are pre-scheduled automated sales set up months, sometimes years in advance. They do this specifically to avoid any accusations of insider trading.
So Tim Cook did not wake up on April 2nd, look at a descending triangle on his charting app, and frantically hit the sell button.
No, definitely not.
So it's completely automated. It's basically just how he cashes his paycheck.
For the most part, yes, it's routine liquidity.
Okay, that makes sense.
However, even if it is a pre-planned mechanical sale, the optics still matter to the broader market.
The perception is reality.
Exactly. When you combine high-profile executive selling with the fact that Berkshire Hathaway, historically one of Apple's most loyal institutional believers, has reduced its stake, it creates a highly fragmented sentiment landscape.
It's just massive mixed signaling.
Complete confusion.
You have options traders looking at the long-term trend and betting on a bounce. You have Warren Buffett taking chips off the table to manage risk. And you have insiders mechanically selling shares. Nobody fully agrees on the next move.
And that lack of unified conviction is exactly what causes a stock to consolidate sideways.
The smart money is hedged.
The smart money isn't moving as a single block right now. It's aggressively hedging its bets.
Which forces us to look at the math beneath the sentiment. With insiders taking profits, institutions reducing stakes, and retail investors potentially walking into a technical trap, we have to ask the ultimate valuation question.
Is it undervalued or a trap?
Exactly. At roughly $266 a share, is Apple genuinely undervalued right now, or is it an overvalued value trap?
Well, let's look at what the analysts are saying first.
Right. The consensus rating across Wall Street is a moderate buy. The price targets average out to $301.33.
Which implies about a 13% upside from here.
And the most optimistic target is a lofty $350 from Wedbush.
But there's a very strong bearish counterargument to those targets.
Yeah, the bearish valuation claims are intense. Multiple financial models, specifically discounted cash flow and GF value models, try to calculate the present value of the company's future cash.
And what do they show?
They show that the stock is actually trading at an 11% to 36% premium. They estimate the true intrinsic value of the stock to be somewhere between $170 and $241.
That is a massive gap from where it's trading today.
A huge gap. And the PE ratio, the price to earnings multiple, currently sits at 33.68.
Which is high for them.
Significantly higher than its 5-year median of 29.55. Buying Apple right now feels a bit like buying a luxury mansion at the absolute peak of the housing market.
Oh, that's a great way to put it.
Right. Sure, it's a gorgeous house, the foundation is completely solid, but you're paying a massive 33x premium just for the neighborhood.
That luxury mansion comparison hits the nail on the head.
Yeah.
When you buy that house at a premium, you aren't paying for the wood and the bricks. You are paying for the brand, the security, and the scarcity.
The moat.
Exactly. Apple commands a 33.68 PE ratio because it has an almost unassailable economic moat. But the mathematical reality of a high valuation multiple is that it inherently limits your future upside.
Because if the PE ratio is up to almost 34, it sounds like investors are already pricing in a flawless future. There is zero margin for error.
Zero margin. Think of the PE ratio as a rubber band, stretching between the stock's physical price and the company's actual real-world earnings.
Okay, a rubber band.
Historically, Apple's rubber band rests comfortably around a 29 multiple. Right now, it's stretched taut to almost 34.
It's under tension.
A lot of tension. For the stock price to travel up to that $350 target Wedbush is talking about, one of two things has to happen.
What are they?
Either the company's actual earnings have to absolutely explode to relieve the tension, or the market has to be willing to stretch that rubber band even further, maybe to a 40 multiple.
And eventually, it snaps.
There is a limit to how much investors will pay for a single dollar of earnings before that band snaps. The bear argument is that at a 33.68 multiple, the stock is priced for an environment of flawless execution and infinite growth.
Which is impossible.
Right. If they hit a regulatory speed bump or iPhone sales plateau the multiple contracts, the rubber band snaps back.
And the stock drops.
The stock price drops rapidly even if the underlying company is still highly profitable. That is the very essence of a value trap.
Wow. But valuations and multiples only matter until a major catalyst changes the game entirely, right?
And Apple has some massive catalysts coming.
A huge wave of them. We really need to outline the best-case recovery scenarios and the worst-case continuations lower, looking at both the short and long-term horizons.
Let's start with the short term.
Okay, short-term meaning literally weeks from now. All eyes are on the Q2 earnings report coming up on April 30th.
Right, and Morgan Stanley is already expecting a beat and optimistic guidance.
But the medium and long-term outlook is where the fundamental DNA of the company is shifting.
This is the big one.
Yeah, on September 1st, come 26, Tim Cook is going to transition to executive chairman.
And John Ternus will step up as the new CEO.
Exactly. Meanwhile, the market is waiting on an array of major product catalysts. The rollout of Apple Intelligence AI features, the long-rumored iPhone Fold, and new M5-powered Macs.
It is a critical juncture. The transition from Tim Cook to John Ternus is not just a change in names. It's a massive shift in corporate philosophy.
How so?
Well, Tim Cook is the undisputed master of supply chain logistics. He turned Apple into the most efficient, profitable machine in corporate history.
Operations guy.
Exactly. John Ternus comes from hardware engineering. It's a pivot from operational optimization back to product-led innovation.
Which is exciting, but also risky.
Very risky, and this transition is happening at the exact moment the company faces severe structural threats.
So what does this all mean? Tim Cook stepping down this September is a seismic shift. Does the market actually want this kind of uncertainty at the top, right when they need to execute an AI supercycle?
That's the tension. Investors are trying to balance the risk of a leadership transition against external threats.
You're talking about the regulatory headwinds,
Yeah.
the U.S. Department of Justice and the European Union.
They are circling.
But how do those agencies actually threaten Apple's bottom line? We know services revenue is their profit engine, but how does an antitrust lawsuit actually derail that?
It attacks the walled garden. The DOJ and the EU are targeting the exact mechanisms that make Apple's services revenue so profitable.
The 30% cut.
Exactly. They are going after the 30% cut Apple takes on the App Store, the default search engine deals with Google, and the closed ecosystem that traps users into using Apple Music and iCloud.
So if they lose that,
If regulators force Apple to open its ecosystem to third-party app stores or alternative payment processors, those Heimelmann services revenues could take a massive, permanent haircut.
so that is a huge weight pulling on the bear side of the rope. You have regulatory threats, aggressive competition eating into their market share in China,
Right. China's a tough market right now.
plateauing overall iPhone sales, and a 34 PE multiple that inherently limits upside.
It's a lot of pressure.
But pulling on the other side of the rope is the allure of the AI supercycle.
The bull case.
Exactly. The argument for buying the stock now is based on strong baseline growth, the sheer power of their luxury branding, their consistent share buybacks, and this upcoming AI-driven wave.
Which could be historic.
If Apple Intelligence requires a new phone because the old chips just can't process it,
Well,
that's hundreds of millions of people forced to upgrade at once.
that is the ultimate trump card. An upgrade supercycle happens when a new technology is so compelling or so computationally demanding that users who normally wait 3 or 4 years to buy a new phone are forced to upgrade immediately just to access the new features.
So you have to buy the new hardware to get the software.
Exactly. If Apple Intelligence delivers a must-have on-device AI experience, it triggers a tidal wave of hardware sales.
And that fixes the earning side of the PE ratio.
Right. When you combine that hardware surge with a potential iPhone Fold and the M5 Silicon, you generate the exact kind of explosive, unprecedented earnings growth required to justify that high 34 PE multiple we just talked about.
It is just a remarkable tension. You have investors completely paralyzed in a massive tug of war.
It really is a standoff.
We are looking at a company putting up record-breaking financial numbers, pulling in $143 billion a quarter, and sitting on $45 billion in pure cash.
A fortress.
Yet its stock is caught in a flat, dangerous technical channel, with a looming descending triangle pattern pressing it down against a $250 floor.
The trash compactor.
Exactly. You have insiders mechanically selling shares, institutions trimming their exposure, and options traders blindly betting on a bounce.
Mixed signals everywhere.
And hovering above all of this is a sky-high valuation multiple that demands absolute perfection, right as the company prepares to change its CEO, fight off international regulators dismantling its App Store margins, and attempt to launch a revolutionary AI product cycle.
It is the very definition of a high-stakes pivot.
A pivot that could go either way.
The next few months aren't just about minor price fluctuations on a chart. They're about defining Apple's trajectory and its risk profile for the next decade.
Which leaves you, the listener, with a really fascinating decision.
It does.
With a new CEO taking the reins in just a few months, and the promise of Apple Intelligence on the horizon, are you willing to pay a luxury premium right now to ride the next tech supercycle? Or are the charts telling you to wait for the trap to spring and buy the dip when the algorithmic selling finally breaks the floor? Thank you for joining us on this deep dive.